Welcome to the debate. This is breaking news to trading moves. What if I told you that the most beautiful, visually pristine chart on your screen is actually the exact one most likely to blow up your trading account?
Oh, wow. That is quite the claim to start us off.
Right? But think about it. Usually, when we evaluate a complex physical structure, let us say a skyscraper or a suspension bridge, we rely really heavily on the visual blueprints. We look for symmetry, clean lines, and, structural logic that we can literally see with our own eyes.
Yeah, and if the architecture looks immaculate on paper, there is just this natural assumption of safety.
Precisely. The human brain is completely hardwired to seek out that kind of visual order. We naturally associate neatness with reliability. We crave that visual comfort. But then you step into the environment of financial markets, and suddenly that exact assumption becomes a massive vulnerability.
Because the market is not a building.
Exactly. We're looking at a landscape where market participants constantly evaluate price charts, seeking out that same architectural perfection. A neat trend line, a clear breakout, a textbook support level, or a completely smooth pullback.
And it feels just as comforting as looking at a perfect blueprint. I get that.
It really does. But the reality is that visual elements do not automatically guarantee a high-quality trade. So today, we are examining the tension between visual chart clarity and the actual quality of the trading decisions that follow. The central question we have to address is this: does a visually clean chart act as a necessary foundation for repeatable decision-making?
Oh, and this is where I stand. Does aesthetic simplicity inherently create a dangerous illusion of certainty that actively works against the trader?
Right. We are taking opposite sides here. My position is that clean charts are vital, clarifying tools. They require structured rules, sure, but they serve as the absolute baseline for any disciplined process.
And I take the contrasting view. I argue that these visually clean charts are very often just visual traps, substituting aesthetic perfection for actual probability and leading traders into a completely false sense of security.
I think the best place to start is by just looking at the reality of how a trader operates day to day. A simple, visually clean chart is a strict prerequisite for executing a disciplined trading plan. Consider the alternative.
You mean the cluttered screens?
Oh, it is a mess. You constantly see amateur traders attempting to process chaotic, cluttered charts. They add 10 different indicators, multiple moving averages crossing over each other, stochastic oscillators.
Which, for anyone unfamiliar, are just those squiggly momentum lines at the bottom of the screen.
Yeah, the ones that supposedly tell you if a market is overbought or oversold. They add complex color-coded zones and automated buy-sell arrows. That kind of visual noise only creates confusion rather than confidence. The objective of trading is to make decisions repeatable over a long series of outcomes.
Well, sure, repeatability is the goal.
But you cannot achieve repeatability if you are constantly trying to decipher a messy web of conflicting data points. By stripping away the noise, a clean chart forces you to look at the raw reality of price action. You can actually make a clear, definitive choice.
I come at it from a different way. Okay, I will give you that. A cluttered chart full of 10 conflicting indicators is a nightmare. But that does not let perfect charts off the hook. In fact, their perfection is exactly what makes them so dangerous.
Dangerous? How so?
Because traders routinely confuse visual clarity with trading clarity. Markets do not pay traders for maintaining organized visuals. My position is that a simple chart frequently acts as a disguise.
A disguise for what, exactly?
For critical structural flaws that actually dictate the outcome of the trade. You can have the most visually perfect trend line in the world, but if you look past the aesthetics, you might find dropping volume, poor risk-reward metrics, low statistical probability, or even impending news risk. The simplicity of the chart lulls the trader into a state of total passivity.
So they just stop thinking.
Exactly. They see a clean setup and assume the answer is obvious. They entirely forget that the market is a highly complex auction mechanism. The market simply does not care how pretty your geometry looks on a screen.
That actually makes me wonder about the psychology behind this. Because, when I see a perfect triangle breakout, my brain immediately thinks easy money. What exactly is happening in a trader's head at that moment? You suggest it breeds overconfidence.
It absolutely breeds overconfidence. Let us walk through the exact mechanics of what happens. A trader opens their charting platform and sees a textbook breakout forming. The consolidation is tight, the resistance level is perfectly flat, the higher lows are marching up exactly as the textbooks describe.
And it looks beautiful.
Right. So what happens psychologically? They get a massive dopamine rush. The trader feels a sense of mastery because they recognize the pattern. They look at that breakout and assume it simply must continue.
Or they see price hitting a perfect horizontal support level.
Yeah, and they assume buyers are firmly in control just because it looks so obvious. Because the visual is clean, the decision becomes rushed. This overconfidence leads directly to poor execution. They size their position way too big. They skip waiting for actual price confirmation, and they completely ignore the reality of risk.
The visual perfection basically short-circuits their critical thinking.
Exactly that.
I see why you think that, but let me give you a different perspective. What you are describing is a failure of the trader's individual discipline. It is not a failure of the clean chart itself.
I disagree. The chart is the catalyst.
But a clean chart should actually make the analytical process clearer, not make the trader careless. If a trader sees a pristine breakout and decides to recklessly double their position size without confirmation, well, that is a direct violation of their risk management parameters. It has nothing to do with the fact that the resistance line was drawn neatly.
But the neatness of the line is exactly what triggers the abandonment of the rules. The aesthetic perfection creates an illusion of certainty in an inherently uncertain environment.
I am just not convinced by that line of reasoning. True discipline requires clarity to function. If a trader actively asks the most crucial question in trading, which is, what would prove this trade wrong, the visual simplicity is precisely what allows them to identify their invalidation levels.
Let us define that for everyone listening, just to be clear.
Good idea. An invalidation level is just the exact price on the chart where you have to admit your trading idea is dead wrong. If I have a clean chart, I know exactly where my thesis is incorrect. If price closes below that single distinct support line, I am out.
Assuming you actually cut the trade.
Right. But if my screen is cluttered with moving averages and algorithmic bands, I can always find a reason to stay in a bad trade. I might say, well, it broke support, but it is still above the 50-period moving average. The clean chart removes the excuses. Overconfidence is a psychological flaw. The clean chart is just a mirror reflecting whether you have the discipline to follow your own rules.
I am sorry, but I just do not buy that. Let me tell you why. The premise that a clean chart naturally points you to your invalidation level completely ignores the reality of how market liquidity works.
How so?
Price action is always uncertain. The cleaner the setup looks, the more a trader needs to slow down, not speed up. A neat trend line actively distracts a trader from looking beneath the surface. When retail traders see a perfectly clean support bounce, institutional algorithms often see a pool of obvious liquidity to hunt.
Wait, let us break that down for the listener. When you say institutions hunt liquidity, what is the actual mechanism there? How does a perfectly clean chart actually mask that trap?
It is a great question, and it is the core of why visual perfection is a trap. Imagine a completely flat, perfect support line at exactly $100. Thousands of retail traders see that beautiful line.
And they all buy at $100?
Exactly. And they all place their stop-loss orders just below it, maybe at $99. Now, what is a stop-loss? It is an automatic order to sell. So you have a massive cluster of guaranteed sell orders sitting right below that perfect line.
Right, a giant pool of liquidity.
Now, put yourself in the shoes of an institutional algorithm that needs to buy a massive amount of shares. If they just buy them all at once, the price will skyrocket. They need sellers. Where are the sellers?
Clustered right below that perfect support line.
Exactly. So the algorithm pushes the price down slightly, breaks the perfect visual line, triggers all those retail stop losses, and uses that flood of sell orders to fill their own massive buy position. Then, the price reverses and goes higher. The retail trader gets stopped out entirely because they trusted the clean visual layout.
So you are saying the visual clarity is exactly what trapped them.
Yes, they placed their stop exactly where the clean chart dictated, which is exactly where the larger participants knew the stops were located.
That is a compelling argument. But have you considered that you are expecting the chart to do the analytical work for the trader?
No, I am saying the chart misleads the trader.
Think of a visually clean chart like a well-organized workspace. Let us say you are an architect drafting a blueprint. A tidy, well-lit desk with your instruments perfectly arranged does not design the building for you. You still have to do the complex mathematical calculations. You still have to understand physics and load-bearing walls.
Sure.
The tidy desk simply prevents the errors caused by disorganization. It stops you from misplacing your tools or spilling coffee on your calculations. In trading, a clean chart is the tidy desk. It prevents cognitive overload. The trader still must do the analytical work regarding volume, market context, and potential liquidity traps. The chart can't do that for them.
Your analogy actually proves my point, though.
How does it prove your point?
Because a tidy desk does not stop a bad architect from designing a building that collapses. In fact, the tidy desk might make the bad architect feel incredibly professional and competent right up until the moment the structure fails.
That is a bit of a stretch.
Not at all. In the market, walking away from a beautiful chart because the context or timing is wrong is one of the hardest things for a human being to do. The aesthetic pull is too strong. The trader sees the tidy desk, assumes the work is already done by virtue of the organization, and executes the trade without checking the underlying structural integrity of the market.
I hear what you are saying about the emotional pull, but I am struggling to see how a messy chart solves that. If a clean chart is a hazard because it might cause complacency, aren't we just choosing between two evils? What is the alternative?
It is not about making the chart messy.
Because I guarantee you walking away from a bad trade requires the chart to be readable in the first place. You cannot accurately assess whether volume confirms a move if your screen is so heavily layered with visual artifacts that you cannot even see the price candles properly.
The alternative is not visual clutter. The alternative is radical skepticism toward visual simplicity. When the chart looks perfect, the trader's immediate response should not be execution, but intense suspicion.
Intense suspicion? That sounds exhausting.
It is necessary. They must actively search for the hidden flaws. The news risk that might drop in 5 minutes, the larger timeframe trend that conflicts with the immediate setup. The problem is that visual appeal leads directly to emotional attachment, and this brings us to a massive trap in the industry, trading the setup versus trading attachment.
Elaborate on that distinction for me. What does trading attachment actually look like in practice?
When a trader relies too heavily on the aesthetic quality of the chart, they fall in love with the setup. Let us say they enter a trade because the pullback was visually flawless.
Okay.
But once they are in the trade, the market dynamics change. The volume dries up. The price starts to stall. It chops around. The trade is clearly moving against the original plan. But what does the trader do? They stay in the position.
Because they are anchored to the entry?
Because they remember how good the chart looked an hour ago. They are no longer trading the reality of the present market. They are trading their emotional attachment to a visual memory.
Ah.
It is like refusing to sell a used car that breaks down every week just because it has a flawless, shiny paint job. You are trading the paint, not the engine. The visual appeal anchored their expectations so deeply that they substitute real analysis with blind hope.
That is a great analogy with the car paint, though I would definitely frame the solution differently. I agree completely that hope is not a strategy. The moment a trader relies on hope, capital destruction is inevitable. But again, you are attributing a failure of process to the tool itself.
Because the tool encourages the failure.
I disagree. Clean decisions are what protect capital, and clean decisions stem from a structured plan. A clean decision means knowing exactly what to do if the trade does not behave as planned. The visual aesthetic, that beautiful pullback you mentioned, is merely the starting point of a comprehensive plan. It is the catalyst for the analysis, not the entirety of the trading edge.
But you cannot separate the human emotional response from the catalyst. We are visual creatures. When the catalyst is aesthetically pleasing, the subsequent analysis is inherently biased.
Biased in what way?
The trader starts looking for reasons to validate the beautiful chart rather than reasons to reject it. They see a massive, clean breakout. The chart looks incredibly bullish, and they buy the top right before the inevitable mean reversion.
Let us clarify mean reversion quickly. That is the concept where price stretches too far in one direction, like a rubber band, and eventually has to snap back to its historical average, right?
Exactly. The rubber band is stretched to its absolute maximum. But visually, on a clean chart, that maximum stretch looks like the most powerful, perfect trend you have ever seen. It looks like it will go up forever.
Which is the trap.
Yes. The aesthetic creates a specific type of vulnerability. The trader forgets to ask if the move has already happened. They buy right before the rubber band snaps back in their face. The chart looked perfectly clean, but their timing was entirely wrong because they trusted the visual without questioning the mechanics.
I must push back on the idea that we cannot overcome that bias. The most elite operators in financial markets do exactly that every single day.
Sure, but they are the minority.
Visual setup, and then they execute a rigorous process of validation and invalidation. They understand that a setup that looks perfect can still fail simply because probability dictates that a certain percentage of all trades will fail.
Right.
The difference is that when the elite trader is wrong, the pristine nature of their chart allows them to see the failure immediately. There is no ambiguity. The price crossed the line, the thesis is dead, the trade is cut.
And I would argue that those elite operators have learned to completely disregard the pristine nature of the chart.
Disregard it entirely?
Yes. They're looking at order flow, the actual buying and selling volume occurring at specific prices. They're looking at how buyers and sellers are negotiating value. The line on the chart is secondary to the underlying mechanics of supply and demand.
Okay, but for
the vast majority of market participants, the clean chart is not a tool for swift invalidation. It is a siren song. It whispers that the market is predictable, organized, and safe. That is a dangerous illusion. Price action is inherently chaotic. Trying to map perfect geometry onto chaos is a coping mechanism. The cleaner the setup looks, the more likely it is that you are missing the actual mechanics driving the price.
That suggests that technical analysis in its visual form is entirely misleading. But the market itself generates these patterns based on collective human behavior. A neat trend line is not an illusion. It is a historical record of where buyers repeatedly stepped in to defend a price level. It is empirical data.
It is empirical data about the past, yes, but traders use it to project certainty onto the future. That is where the disconnect happens.
Well, nobody has a crystal ball.
Exactly. The trend line tells you exactly where buyers were yesterday. It does not guarantee they are still there today, especially if the macroeconomic context is altered or if a major institution is finished accumulating its position and is ready to let the price slide. The visual clarity of the trend line masks the invisible absence of the buyers.
Which brings us right back to the necessity of a repeatable process. You are correct that the past does not guarantee the future. No professional assumes it does. What the clean chart provides is a defined location to test the hypothesis.
Test the hypothesis, sure.
I enter at the trend line not because I am certain the buyers are there, but because if they are not there, I will know immediately and with minimal financial damage. The clean chart optimizes my risk-to-reward ratio. I risk a very small amount of capital just below the line to potentially capture a much larger move if the historical pattern repeats. That mathematical edge is impossible to execute if the chart is a chaotic mess of indicators.
I agree that a messy chart is detrimental. But the danger of the visually perfect chart remains the central issue for most traders. When they test that hypothesis, as you call it, the aesthetic beauty of the setup often convinces them to risk far more capital than they should. They violate their sizing rules because the setup looks too good to pass up.
I believe we are arriving at a point of summary here, as we have pretty thoroughly mapped the mechanics of how visual information impacts execution. My position remains that a clean visual baseline is an absolute requirement for long-term survival in the markets.
And I maintain it is a hazard.
Visual simplicity is what supports a repeatable, rule-based process. It strips away the cognitive overload, allowing a disciplined trader to clearly define their entry, their stop loss, their target, and their overall risk. The visual aesthetic does not do the work for you, but it provides the necessary architectural foundation to make clean decisions, protecting your capital when the market inevitably moves against your hypothesis.
And my stance remains that traders must maintain a posture of extreme skepticism toward perfect-looking setups. While clutter is entirely unhelpful, visual simplicity is a natural psychological hazard. It masks the complex, often chaotic reality of market mechanics.
It hides the flaws, essentially.
Exactly. A simple chart can hide fatal flaws like weak volume, liquidity traps, and poor timing. Traders must recognize that visual appeal is not synonymous with trading edge. Staying in a trade purely because the chart looked good earlier is a path to emotional and financial ruin. You simply cannot judge a trade by how attractive the chart appears.
It is clear that we have found some crucial common ground today, though. We both absolutely agree that capital protection is the paramount directive. Protecting your account requires knowing exactly why you are entering the market, precisely where your thesis is proven wrong, and exactly how much capital you are risking on that specific outcome.
Yes, we are fully aligned on that. The necessity of a rigid risk management protocol is non-negotiable. What you do when the trade does not behave as planned dictates your survival.
Where we continue to disagree is on the nature of that visual baseline. I view a visually flawless chart as a helpful, necessary starting point that clarifies the process. You view it as a natural psychological trap that actively distracts from the deeper, necessary questions a trader must ask.
Exactly. We disagree on whether the visual perfection empowers the trader or blinds them to the risks. Because, the market does not reward aesthetic appreciation, it rewards probabilities and execution.
This requires all of us to critically examine our own daily processes. The requirement to separate visual appeal from a genuine trading edge is a constant challenge. So I want to leave our listeners with what we could call the ugly truth rule.
Oh, I like the sound of that.
For every hour you spend admiring how clean a setup looks on your screen, spend 5 minutes actively trying to destroy your own thesis. Look for the liquidity traps, check the volume, and ask where you are wrong.
That is an excellent rule. It demands intense self-awareness and forces you to look past the paint job to inspect the engine.
And that leaves us with a final reflection for anyone engaging with the markets. The next time you find yourself drawn to a pristine setup, ask yourself, are you evaluating the actual statistical probability of the trade, or are you just buying a house because you fell in love with the curb appeal? We will leave that for you to consider.